Good morning. It is mid-morning on the S&P 500, and price market volatility has increased to such levels such as 1999 and certain levels even in 2008, and people are caught off guard. They don't know how to trade true volatility. What you need to know on the S&P 500 this morning, the high was 1218. We sold that opening and equities went tumbling down. We had a short-term bounce and we made an all-time low down here where I talked about the S&P getting a footing at 1180. We undercut it to 1168. Look at the amount of selling down. It opened at 1200, goes up to 1218 and then capitulates, and mid-morning we get a big bounce. And when bottoms are attempted in price volatility, they like to do it on a Friday. Not only that the price volatility increases at bottoms, but price volatility also increases at tops. So when a bottom is going to put in a market, you're going to see even a higher volatility increase, expansion, meaning that the volatility will expand to levels that people cannot adjust to, let alone think they can trade. However, as understanding all of the components and everything involved, it makes it quite easy to go when the math is going this way. So that's a great short, and the equities fell to their all-time lows. When the S&P put that bottom in, that correction on the S&P, they stepped in and they started buying mid-morning on August 5th of 2011. And price action volatility to the upside needs to be as great in value as it is downside volatility value. Upside volatility value must be the distance of equal distance of both mathematical ranges. If they are not, and we do come back, it's how the longer term structure of the S&P sets up this current bottom that is an attempted bottom on August 5th of 2011 on a Friday afternoon, when the recipe for the oversold condition to bounce. It's how we go moving forward, how the volatility will increase. Volatilities increase at bottoms, and it could be a number of days and weeks. You're in the dog days of August, and a wonderful, wonderful tape.